for the first few seconds. Okay, it's excellent, Raj. I think what we'll do is we'll get going because we have over 21 people on the line, and good afternoon or good morning or good evening. I know we have some registrations from the UK, we have some from the UAE, we clearly have some from India. We have Raj in Singapore today. So whichever part of the world you are, welcome to this session with Raj Dugar. For just as an anecdote or a sidebar, Raj is currently sitting in quarantine in Singapore, where he has an office, and he flew there a few days ago. It's his last 48 hours of being quarantined. So I think we're fortunate to have his time because I'm sure the moment he's out of the quarantine, he's going to get busy and doing some deals and handing some companies some money, Raj. So anyway, welcome to this webinar. I want to thank Raj for doing this for us. He's an old friend of mine, and I'll obviously introduce him briefly, but he's an old friend, and I requested him to do it. And I'm pleased to have a number of Stern alumni and NYU alumni sign up, but I also know, because the invitation has been circulated to other US schools alumni in India, that many of them have also signed up. I saw a few names on the list that I have in terms of registrations. Yeah. So
Perfect.
with the other last comment I'll make, general comment, is that, well, I hope everybody is safe, and whoever's had COVID and survived that, good luck with all the antibodies that you've got. But I hope everybody stays safe. And with that, I'll do a quick intro. We did obviously send out Raj's background, so I'm not going to read the whole paragraph, but Raj has obviously gone to a better school that I may have gone to in any case, but who knows? But Raj has well, I know he is a double undergraduate from Dartmouth in engineering and economics, and then went to MIT, and has been in the private equity industry for over 20 years. He's obviously worked with some marquee funds, with Goldman Sachs, and as a technology investor, and Carlyle. And he's been with what's Eight Roads, but I guess used to be and currently is, and Raj will explain in more detail, the P fund component of what used to be Fidelity's investment arm. And he's been with them for some time. And I reached out to Raj because, firstly, whether we like it or not, NYU Stern has never been able to get rid of the tag, Raj, of being a finance school. And I remember when I went, I was there in the 83, 85 time frame. It was a finance school then, and I think, to the best effort of all the deans that have come and gone, the reality is it's still a finance school, but a great finance school. And therefore, NYU Stern alumni end up in the financial services industry, either as bankers or as investment bankers, or in the private equity industry. And there are a number of them in India who are in the VC and PE space, right? So I thought it was a good area to talk about. And it was especially a good area to talk about because the pandemic disruption of COVID-19 obviously would have had an impact on your industry, very much like it has had, mostly negative for a lot of other industries. Obviously, there are some industries such as IT services or online, or some segments of the pharma industry that has done better. But for the most part, it's been a tough situation and continues to be a tough situation because countries around the world are still struggling to get this under control, right? So I thought it would be fascinating to hear, from you on the ground realities of what's happening in investing during this era. I did ask my team. I don't run a private equity fund, so I have no cash to distribute, but we do some research. And I did ask my team to see what data they could pull up, right? And therefore, just a couple of data points, and then we'll go into the conversation, right? But I mean, what I have right now with me, and this is sourced from Bloomberg and PitchBook, and I think it's important to identify the sources. But according to what they said on a global perspective, was that the deal values fell by 35% year to date, and volumes 42%. So it seems to be that there's been some drop on the global platform. There were 7 mega deals. There are valuation markdowns somewhere between 8 to 22%. So that's some of the global numbers that I saw. On the Asian perspective, the private equity and M&A fell by about 47% in Q1 2020. Just for a data point, Q2 2020 was 38 billion in Asia, and the volume was 150 odd deals in Q2. But it's done better than other parts of the world, and there's been some taking private. Um, and the dry powder, which I assume you have also, Raj, is a healthy 400 billion plus. So there's money to invest. And if I just drop into India, which is going to be the focus of our conversation to a large extent today, is that the drop P deals fell by about 40%. The volume was off by about 33%. Again, in terms of numbers, it's down from 47 billion for 2019. That's the number I have. This is IVCA data. Down to 28 billion for 2020 year to date. And in terms of volume, about 1,000 deals in 2019 at 686 for this year to date. By the way, 2018 was 767, so it's not significantly off the 2017 number, from what I can see. And I won't go to the deal list, but in essence, I just wanted to kind of read off some numbers. So there seems to be, to summarize, there seems to be some fall off on volume and value, but there seems to be a good amount of dry powder. And I suspect that just like you guys like to take advantage of an opportunity a firm provides, I'm sure you guys want to take an opportunity that COVID-19 provides to your benefit, right? So with that introduction, Raj, you want to talk a little bit about Eight Roads to start with, and just in terms of the firm and the investment strategy and the type of investments to date? Maybe we start there.
No, thank you. Thank you, Sanjeev, for the really warm introduction. I'll make a 2 or 3 sort of overarching comments, and then maybe we can get into meat of the discussion. Look, first of all, just a really warm thank you to everyone who's joining. And I know it's middle of a work day. Everyone is busy, even if they're working from home or their offices. And hopefully, we can have a good conversation, and there's, some take-home value to the participants who have joined and taken the time out in the middle of the day. The other couple of other points I'll make, Sanjeev, look, I always have time for you, quarantine or no quarantine. So you could have asked this to me anytime. And look, I'm delighted to address the folks from Stern. It's a school I admire greatly. I've had a good fortune of working with a lot of folks during my career from Stern, and again, have a very healthy respect. And also, when I got this email from you, I immediately shot off an email to some of my colleagues and peers in my respective schools, saying, look, we need to be doing something like this to get our lunch together, right? And of course, in another era, there were lots of mixers and drinking parties, but I think it's just easier to do this now.
Yes.
And always a great way to get together. So lots of admiration for you to put it together. Look, I'll do a quick intro for Eight Roads, but then try to respond to some of the comments which might be more interesting to the audience. Eight Roads is essentially Fidelity's private equity venture capital arm. We've been doing this for 50 years, but we've been a little bit under the radar, partly because it is all our proprietary balance sheet capital. So we're never out raising third-party money from outside investors, and that gives us the flexibility to go a little bit easy on on the marketing aspects and the aspects of building the profile for the firm, a lot of which, as we know, is tied to fundraising, but are really able to focus on the core of the business, which is finding great deals for our LP, which in this case is a single LP Fidelity, and working with our portfolio companies. And I've been doing this for 13 years now, and obviously, do this in India and Southeast Asia, but also as part of our managing partners group, have regional responsibilities and have a close peek into what's happening in all of the other markets, including North Asia, Europe, and the US. Some of the comments and data that you made, I think were interesting, Sanjeev, but I also think is dated because, they were average. And I think to see what's happening, we have to de-average that average. I think a lot of, if you go back to March, I think it was very clear, there were lots of dire prediction around new deals getting done, around the volumes of exits dropping. There was a denominator effect for the LPs saying, look, as the public markets keep crashing and the allocation to alternatives and private equity seem to continue to go up, is that going to have an impact on the new funds that are out there trying to raise, raise money? There was all of this talk of COVID discount and distressed deals and transactions happening more and more. I think if you look back at that now, that seems like just a different world, different era. Fortunately, very little of that materialized, and most of these dire predictions, didn't fall through. As a matter of fact, I think now if you look at us, and equally when I speak to a lot of my peers in the industry, they are busy on multiple fronts. They're busy realizing cash and on exits. The M&A markets are back. The IPO markets have certainly been back. In some geographies more than others, but certainly in India as well. We've seen some of that. We have seen deal flow, deal pace, all of those pick up. So what essentially happened is, look, there was a time back in March or April when we thought some of these predictions might fall out, and people who have been, like me, who've been in this industry long enough, were harking back to, look, are we going to, should we get into a fetal crouch position? Are we going to get into, the 2000 dot-com bust or the GFC, in 2008, 2009? And so, there was a lot of focus on, look, how do we just preserve the value in the portfolio and just make sure that there's a long runway, long sustainability, we can fund and continue to back the companies that we think should come out at the other end of this, in a healthy manner. But I would say that thinking changed very quickly, for a variety of reasons. You can get into it. It was all the liquidity that was there, and clearly, the industry itself, sort of seemed like something that you could call it a K-shaped recovery. You can call it sort of, a couple of different engines going at different speeds. But there were a set of sectors certainly that we were focused on, healthcare, technology, consumer, that seemed to come back with a bang and continue to grow. There are other sectors, of course, like travel, transportation, hospitality, that took a big beating. Although I looked yesterday, Carnival Cruise is up 40% on a single day on the back of a Pfizer vaccine news, and some of that might start coming back.
Correct.
But it was really a tale of two. It was a barbell approach. There were a set of sectors that seemed to be struggling to raise any capital, and there were others where there was a lot of flight to capital. And what that resulted in is, the valuations, pace of deal making, exits, absolutely being at the pre-COVID level, and sometimes probably getting ahead of it. Because the expectation was, if you're playing in technology, anything cloud, so on and so forth, those are sectors that are that are going to survive. So that has been the play. If you ask me or most of my peers today, it feels like the big dreadful impact of COVID that all of us were fearful of never really played out. We are back and busy on multiple fronts. Yes.
Raj, do you think? Well, I'm glad that I'm glad that things have turned positive, and it sounds like, from what you just said, is that the turning around seems to have happened in the quarter after the data that I reported, right? Because it seems to be the last 90 days from that perspective to certain.
Absolutely.
The follow-on comment or question I have: do you feel that you are somewhat more protected as eight roads because of the sectors that you focus on? Because I mean, you mentioned healthcare, which I understand that there's some parts of pharma that haven't done so well, but
absolutely,
fair amount has. Then you mentioned technology, and technology for the most part has done well. And then you mentioned consumer, right? And again, of course, there is a mixed impact, but generally it isn't as bad as some of the other sectors. So, I mean, do you also feel that the nature of your sector focus kind of buffered this a bit for you guys, or you think that that the comments you made would generally apply to most funds who are multi-sector focused or sector agnostic? Yeah.
No, I think it did apply to more sectors. Some of the sectors that we were fortunately focused on, and I would say look, we do technology. We also invest in consumer. We invest in financial services, and some of those did get impacted a little bit more. And maybe we can discuss that. But
Okay.
I think even within these sectors, there were an impact of subsectors. So let's take healthcare. If you look at healthcare delivery, you look at hospitals. What happened in the first 4 or 5 months is the hospitals went through a really difficult time because, look, hospitals make a lot of money from elective surgeries, but anyone who was trying to get a knee replaced or trying to go for their normal checkups, and so therefore the number of cancer patients, the number of patients who are getting elective surgeries done, be it getting a stent put in or anything of that sort. People where they had the luxury to push things out a quarter or two said we could. That's changing now. In fact, the hospitals are back incredibly busy because I think patients are increasingly realizing that you cannot keep pushing this out forever.
Correct.
And so hospitals went through that. Pharma, testing, diagnostics companies of that sort, obviously, had really strong tailwinds through this.
Yep.
Remember when COVID was happening, there was another big thing that was playing out, which was sort of the US-China trade war, and there were big discussions around shifts in supply chain. And we had a lot of pharma companies starting to prepare themselves for some of those changes. And so you had Indian companies, either pharma companies either backward integrating and saying, look, how do we, if you are manufacturing formulations, how do we get into APIs and intermediaries before that so that we get self-reliant? This was sort of our take on Atmanirbharta or just making sure that we have a supply chain that we can absolutely fully rely on. So some of that was happening with the pharma companies, and the focus was there. But that demand didn't go away. The chronic patients who needed the medication needed it. If anything, there was a little bit of hoarding of medication. So you saw a spike on some of these. So because people just didn't know if you could go out and if pharmacies would be shut, and so people typically bought for a couple of weeks, now started stocking up for 2 or 3 months. And so, we saw a slightly different pattern there. Consumer, was interesting. I think you saw, certainly, a quarter where there was a lack of consumer confidence and with the economic uncertainty and, sets of things that people could put off purchasing. We certainly saw a shift in mix in terms of what people were buying. So, and even when we spoke to the larger FMCG companies, they said, that's exactly what they, so overall, the headline numbers stayed the same, but there was a big change in mix where, somebody who was probably buying, a Pears or a Dove is now buying a Lifebuoy soap. Right. But at the same time, people who are buying loose, sugar or atta or dal were now buying packaged goods because of the hygiene and so on and so forth. Yeah. And so the Indian consumer obviously is very smart. She's always evaluating how I'm going to spend the money and where do I need to trade up, where do I need to trade down. So we saw some of those changes and shifts happening. Financial services, entirely different industry. A lot of fintechs, including eventually. Lending is a big part of that, and there was both a concern around, look, is there going to be a spike in in bad loans, and therefore the pace of dispersals came down. The companies that had raised money prior to that and had strong balance sheet, certainly suffered from negative carry because of they were not able to lever up and continue lending at the same pace. Right. Some of that still continues. I think financial services are still are trying to find their footing, to the pre-COVID levels, and that's playing out. And some of this is regulatory. We're coming out of the moratoriums and so on and so forth, and this will play out. But so yeah, it doesn't apply necessarily to all sectors, even where we focus on. Some have been better than others. Yes.
Now, Raj, just tell us a little bit about the portfolio you have in India, right? So,
sure.
Roughly number of companies and the total amount of money you invested.
So we have about 40 companies. We have about $1 billion under management in India. Roughly split across those two categories. I would say healthcare and then what we call TCF, technology, consumer, and financials.
Got it. Right. And the vintage is what? I mean, you would say the vintage of your investments would be what? So
we started getting really active around the 2012, 2013 timeframe. Prior to that, we had a very different type of fund, which focus on a set of sectors that we don't focus on anymore. It was infrastructure, it was manufacturing, it was much more of a generalist private equity firm. But I would say under this new strategy and new focus, we've been active with this, for the last 7 years or so.
So would you say that most of these firms are at the three or fifth year point, or they're towards the end of the typical investment cycle a PE fund would have, or uh,
Yeah, so
where would it be?
yeah, I think it's a good question, and what we do, Sanjay, with eight roads, and obviously, it'll be different for different firms, is we focus on what we call early growth,
Right.
and so we aren't quite early stage venture capital,
Yeah.
and we certainly are not a buyout firm, but we are also not a very late stage, so our check sizes, you do the math from the numbers that I told you,
Yep.
sits in what we would call early growth and growth stage companies.
Right.
And the reality is, in some of the emerging markets, and particularly in India, the hold period for some of these companies has got to be longer, right?
Okay.
And so when you speak to people in some of the other more developed geographies, in the US or in Europe, they might say, look, it's a 5-year hold period. I think in India that tends to be 6 to 7 years, particularly
Okay.
if you are investing in towards the earlier stage of the life cycle of a company.
Understood. And so, and generally, are you above 26%? Are you below 26%? Or what do you normally at?
Well, we are typically below 50%, so we don't take
Okay.
control, but
Yeah.
we are always what we would call significant minority,
Got
and
it.
that can change.
Understood.
We have companies in which we are, we own north of 40%,
Right.
and in some companies where we own, high single-digit percentages.
Got
So
it.
it's a reasonable range. I think a bigger focus for us is, what are the set of rights do we have? Do we get to play a
Got it.
role, and do we have a seat at the table and a board seat so that
Sure.
we can
It's
work with
it's
the
about
management
the
company?
it's about the non-financial controls that you can have in place rather than financial. Got it. Now,
Influence, I won't even call it
yes.
control.
No. Okay.
Absolutely. Yeah.
And now, just the reason I'm asking these questions is right. So I guess if I was in your shoes and you have a pandemic situation or a GFC, right? I mean, I'm learning the acronyms as we're going along, right? So I can throw some telecoms ones to you today, but but when the pandemic hit, right? I guess what I would do is first look at my existing portfolio and the companies I have there, and see the ones that may need help, right, or may need support, financial or non-financial support or operating support. So if you can just give us a sense that in the early days, right, when this thing hit, is what are the kind of actions that you took with regards to the existing portfolio that you had? Yeah.
No, it's a really good question, and I think, I would say without exception, almost every private equity and venture firm went through their own version of this exercise, and it was really about triaging and making sure that the value that's been created in the portfolio company, how are you able to protect it without fully knowing when we are going to come out of the other side of this. And that had two or three aspects to it. First and foremost, just making sure that companies that were not profitable had enough of a cash runway, certainly for the next 18 months, if not longer, to be able to tide through that. Sometimes they had it. In other situations, we did an external round of financing. And in some of those situations, we stepped in, and along with our co-investors in many cases, provided that financing so that the companies that had a certain type of momentum did not necessarily slow down because of what was happening here. So that was the first thing, just making sure that financially they were adequate. The second thing that I think that we did and took the opportunity at that time, Sanjeev, and I think most most of my peers that you would speak to will probably tell that to you, is that almost without exception, our portfolio companies have become operationally stronger,
Right.
right? Because they had to very quickly move from a world where it was all about growth and customer acquisition and continue that trajectory, to now saying, look, how do I just take a little bit of a breather there, and just make sure that operationally I come out much stronger. So it gave the founders, many of whom were very young founders, they were first-time entrepreneurs, the ability to hit the pause button and say, look, what are the set of things that I need to do to start looking at the cost side of the equation, a little bit more. And they did a variety of things. I think there was clearly greater degree of technology adoption, and digital, all things digital. I think, people have said it in many different ways that, the set of changes they would have expected to take 2 years, got done in a quarter or two. And that's, we've absolutely seen that across our portfolio companies. Second, every single line item of cost was looked at. There were obviously a couple of bonuses, the travel cost, which tends to be reasonably high for companies that are building out their sales effort. They were able to go back and renegotiate costs on their rentals, offices, so on and so forth. And my sense is, almost every single company has come out saying, look, yes, clearly there was a fat that was built in. It was one of those important, not urgent things, but once we, put an urgent label on the cost side of the equation, we were able to go back and do a set of things, which hopefully is going to make them stronger on the other side.
I see.
So that's something the companies did. And so in a strange way, COVID came as a disguise for some of these companies that just, did not have the ability to focus because everything else that was happening in the business to say, look, this is what we need to do.
Understood. So now here's some follow-ons to this, right? So
Sure.
I guess the first follow-on is, so if you've got 40 companies, right? So roughly, for how many of them you had to do an extra top-up in terms of equity?
I think we had to do it for about half a dozen of them.
Okay, so reasonable number. And then how many of them would you have had to either help them renegotiate with their bankers for additional debt or change in terms?
So we tried to do it for a few. Look, the banks themselves, honestly didn't know what had hit them on the face. So I think they were fairly frozen for a period of time.
Got it.
New dispersals, so on and so forth. The companies of ours that were the strongest, had the strongest balance sheet, had the ability to raise more money, but they were not the ones who needed it, and the ones that needed it, had to go through. And I think the only time they were able to do it is if we were able to show them the strength of the balance sheet by putting in more equity, that they were able to go and renegotiate some of that. Yeah.
Understood. So it looks like that whatever additional capital was required had to come from you guys rather than from anybody else, right? Sounds like
from us, our co-investors. In some cases, we were able to also raise it from external investors because, look, one of the things that has happened certainly in the last quarter or two is there were a set of companies that we were tracking, that we might have been in discussions with for a year or longer. And this gave us the opportunity to continue to evaluate these companies and say, look, we still feel that these are investment worthy.
Right.
And so just like we are in process of going out and writing new checks and doing new deals,
right.
We've been fortunate. Some of the other investors equally have come in and have been investing in several of our portfolio companies.
Yeah.
And so deal making hasn't stopped, and if anything, certainly in the last 3 or 4 months, that pace has certainly gone up. Yeah.
Got it. Okay, so that's one question I had. The second question I had related is that when you went back to your firms and asked for cost control, was there a lot of pushback or there was reasonable acceptance? I mean, especially around compensation and headcount.
In the portfolio companies?
Yeah.
It was quite remarkable, I must say. And I've got to just admire the entrepreneurs, including several first-time entrepreneurs. And remember, these entrepreneurs themselves have a network of other entrepreneurs. They're talking to the ecosystem all the time.
Yeah.
I think almost without exception, they started at the top. Where they said, look, the senior members are the ones who can probably during this time most afford to take a little bit of a pay cut. They went ahead and did that. So they set the tone there. And then obviously at the junior most level, there was almost no or very little pay cut. And then, there was a gradient there. But it did start at the top, and I think that served them well.
I have, for example, family member, who's running a VC funded enterprise, quite successful. And when I asked him what was happening on cost and compensation, they literally made no adjustments. And I thought that the VC fund was being more generous than I would have been. And so I'm just wondering whether, this is more, there's more, because these are more mature management teams, they show more understanding of this. And I don't know if, in the VC space, if it was any different, but maybe I just have one
Yeah,
anecdote.
no, and I think even in the early growth of growth companies, even
Yeah,
if you look at our more mature companies,
yeah,
I don't see a situation where we had to go and ask them to say that, look,
absolutely.
I think you need to do this. I think a lot of it came from the entrepreneurs. They
Sure,
saw this.
sure,
They also knew this was temporary.
sure.
They knew that this was,
Correct.
that this was not going to be a permanent reset in terms
Got
of the
it.
numbers.
Got it.
And but I'm not surprised that there were companies, certainly if they had the COVID tailwinds or they continued to perform well, there was really no reason for
I see.
them
Fair
to
point.
look at the
Yeah.
the payroll side of things. They must have taken costs out in other places where they could.
Yeah, and you're right. I mean, the guys are doing well, right? Okay, the
Absolutely.
second question, Raj, is that in these 40 firms, right, were there firms where there was a significant disruption in the business model, right? I mean, let me, where, look, I mean, there was an investment thesis that you had going into the firm based on a business model that they have, and that, just COVID and whatever resulted from it, either the fact that, the growth will disappear for a period of time, or that the distribution channels went from being brick and mortar to online. I don't know, right? Well, so in how many of these firms would it have been about, disruption around technology versus just, that the growth opportunity disappeared and got deferred, right?
So, I would say there were maybe three or four of our businesses that bore the brunt of this because these were, even though there might have been a digital element to customer acquisition or how they did it, it was a very offline business.
Correct.
These were companies that had a retail storefront, that customers needed to walk in, they needed to experience, use, buy the product, and for a period of time, the stores were just shut. So these were companies where we saw revenues literally go to zero. Certainly in the month of April when
Oh,
there was an absolute lockdown, and remember that was a period where even non-essential delivery of e-commerce
right,
goods was absolutely stalled. So whatever revenues that they might have been able to recoup by way of selling online
right,
wasn't there. So there were absolutely companies that fell into that category. Not all of them have necessarily come out of that because for some of these you will need people to start getting back into their offices. You need to people to start commuting. You need people to start going out and having the confidence to get back into the stores to buy the goods. And so it's going to be a little bit of a slow slog, but these are fundamentally good companies that we
right,
like.
right.
And if it took a 3, 4, 5 year view, these are absolutely companies you want to stay invested in because at some point, I certainly hope we are all going to get back to some sense of normalcy, but it might take a quarter or two longer, just given how long what is the ferocity of this second wave or third wave, or I don't know whatever wave we are going to be in, and they're going
Correct.
to be more lockdown and so on and so forth. Yeah.
But let's go to the financial services sector for a second, right? So, obviously, my view on this a little bit is that um, things are still going to happen, right? I mean, there is, I mean, obviously depends on the kind of investments you've done, but whether, if it's a financial institution, typically a lender, a bank, or an NBFC, is that the book is hit, right? So, I mean, and again, it depends on what book they have, how much of it is corporate versus SME versus retail. But I would say, for the most part, there's pain there right now, right? And unemployment numbers may still continue to go up, right? I mean, I don't think we've seen the end of that right now. The sense I get is, yes, a lot of the supply chain around the country is getting fixed relatively quickly, and most friends I talk to say that their plants are getting back to somewhat of being in a normal situation, but the demand side has to be tested, right? And there may be
Yes.
some peaking of demand a little bit due to Diwali and the festive season, but what happens after that, right?
Yes.
So, and therefore this and the stressed book of the on the asset side, the NPA book, you know is going to be there, and it's going to be up, right? uh, and the only way you finance financial institutions is obviously with some equity, but it's more about the deposit book, right? So, and that's the tricky part, right? So you can, irrespective of what the capital adequacy of the institution is, they are significantly dependent on having some extra liquidity, leaving the
Absolutely.
interbanks, right, from deposits, right? So I don't know, offhand, whether do you have investments in any kind of NBFC in financial institution?
We
Which
do.
one?
We absolutely do.
Which one is it? It's in the public domain. Yeah.
No, no, they're all in the public
Okay.
domain. We
Okay.
have an investment in a company called Northern Arc, which is one of the
Yes.
larger, both wholesale, but also now we're
Yeah.
increasing retail
So
book, early salary. So we have a few.
the reason I'm asking these questions is that I'm not so much worried about the HDFCs of the world, right? But I'm just talking about these payment banks or these small finance banks and these suboptimal size NBFCs, right? I mean, what do you think is going to happen to that lot? I mean, irrespective whether you have an investment in them or you don't have an investment in them.
Look, so I think your general observations, Sanjeev, I agree with you that there is going to be some pain in that sector, that's going to play out, in the coming quarters. You know, a lot of the NBFCs had grown very aggressively, and it's that classic saying, when the tide's going out, you're going to find out who's going to swim naked. So we are certainly going to see a rising degree of NPAs, bad loans, and so you're starting to see early signs of that. It's something that we absolutely need to watch out for. And so for a lot of the NBFCs, they are sort of caught in this pincer. On the one hand, they're struggling with the existing book and making sure that they're able to collect and the collections happen, and they're getting paid back. And obviously some of that got muddied and clouded with the moratoriums, and so. There were some people who really needed the moratoriums, others who just took advantage of it, and now you're starting to see post-moratorium, was that just kicking the can down the road for the inevitable for some of them, or are they actually going to, are you going to start seeing some defaults and people missing the payments? So that's one aspect. The second aspect is just the ability to build the liability side of the book. That continues to be a challenge.
Yeah.
You obviously spoke on the banks, small banks, CASA, etc. That
Yeah.
has continued to be strong, but broadly, the banks then lending on to NBFCs, or the NBFC is having other avenues of the
Yes.
liability side. That's unfortunately not going to change. Now, what's going to complicate this further is obviously the cost of cost of borrowing, and I think you're going to see a greater sort of a cleavage between the cost of borrowing for the banks,
Yep.
and the NBFCs, and I think a lot of that will has to do with the credit rating agencies, who
Yeah.
are generally taking a relatively not so positive view, perhaps with some good reasons, but not entirely. I think they themselves are under some heat to make sure that there are not a lot of upgradation. So what you're going to see is banks, who will see probably continued lower cost of borrowing, and so they will continue to perform well, and the names happen well. They might have some more challenges on the asset side, but they certainly won't have challenge on the liability
Right.
side. Is our view. On the for the NBFCs, there's certainly going to be a liability challenge to manage the cost of borrowing. But also on the asset side, do we need to continue lending without having full visibility in terms of how how the credit curve is going to move, etc. So it's going to be a very challenging time. I think the better companies are taking advantage of this period to just collect a lot more data, to use a lot more digital tools, have a lot more visibility, into the end customers, and having more better predictive models to see, look, how is this all going to pan out?
But
But
it
this
also,
is, my sense is at the other end of this. And again, I know Sanjeev, your firm does a lot of work in this area. But hopefully some of these will come out operationally stronger with stronger set of models, because this has been a challenging time for them for sure.
so it sounds like there's going to be some consolidation, right? I mean, books are going to
Without
get
a doubt.
controlled,
I,
right?
I am absolutely.
And then I guess just from an investment perspective, right? I mean, I think we've all known that the price to book of Indian financial services entities has been very high, right? For various reasons, right? I mean, you can PB over JP Morgan at 1.5, and then, I don't know what HDFC is today, but, could be 6 and 7,
But
could
it's
be
run
8.
by the best banker in the world. You
Yeah.
saw that economist piece.
and, and so, so it's been a bit irrational, right? Because of various reasons. So you feel that the valuation in some of the financial services organizations in India will become more realistic from a global perspective? Or you think
You
that
know,
the better ones will continue to just have these amazing valuations and,
I
the,
think the better ones will continue
the
to have an amazing valuation, partly because there's just always, a flight to quality for
yeah,
capital. And there is a set of companies that investors know
right,
are better on almost all fronts, just in terms of the credit processes, and how they run it. Just the CASA and their liability franchise just tend to be stronger.
oh,
I think, and they continue to show very, world-class, world-beating return on equity, and growth. And so these are companies that I think will continue compounding,
I see.
because if you look at the headline level, in terms of look how large, is there still a lot of room and banking penetration and so on and so
Correct,
forth. India
correct,
just continue to have so much headroom that
correct.
these will continue to be growth markets, unlike some of the, and therefore sometimes the comparison to the US and the large banks there isn't a fair one, because these continue to be, growth markets.
Yeah, of course, of course. Understood.
Yeah.
So just to alert everybody on how we're doing on time, and we will end at 3 o'clock sharp. I have another maybe 5 to 7 minutes of questions, and then after that we'll open it up to the audience, where they could, you can send me a question on the chat, identifying your name and obviously the school you went to and the question you have, and I'll be happy to ask Raj.
I hope some people are still listening to us,
No, we're
and
still
yeah,
at 30.
yeah,
We
I've
have,
been
we have,
enjoying the chat.
we have 37 on the chat now. I don't know if they're awake or asleep, but we'll figure
Well,
that
that's good
out.
to know.
Anyway, you and I are having a good conversation. So, so before the last couple of questions, right? I mean, I just since I mean, you know fintechs well, and we know fintechs well, right? So, but there's a lot of hype in fintechs, right? And there's all shapes and sizes, right? I mean, what's the bottom line on it, right? I mean, you would say that the COVID crisis has significantly helped the fintechs, or you think it's somewhat helped them, or just give me a 5 minute sense on where you think the future of fintechs is, right? Be-
So I think COVID has helped anything digital, and I think it's helped the fintechs. It doesn't take away this fundamental question around fintechs, in terms of how most of them are going to make money, right? And by and large, eventually, does it come to some form of lending, which is a key driver for them? It could be buy now, pay later. It could be, some element of, just lending money and saying, look, I've got better credit models, etc. For a lot of the others, in terms of what's happening on payments and remittances and so on and so forth, or even sectors like digital wealth management, they are either very early, or still not enough demonstrable proof points to say, look, can these companies really make make money? So, for example, you look at the number of digital transactions, right? They have certainly, we obviously certainly gone up. We have certainly been making most of our payments now digitally, because you don't want to handle cash and so on and so forth, for
Correct.
obvious reasons. But is the payment provider really making money at the other end? What is the business model? And this notion of, well, I'm collecting data now, and eventually I'm going to monetize that data.
Yeah.
I think all of us want to see some more proof points in terms of how that's going to happen. Or is it all eventually going to converge into, look, let me try to figure out a way, where I can lend and make, basically a spread on that. Uh, Even things in payments like, your merchant discount rates, your MDRs, your interchange, etc., will probably continue to come down, and people were building their business models to say, look, that's how we're going to build a business model around it. You're starting to see more and more bigger players come into it, be it merchant acquisitions and POS businesses. So I think I absolutely predict there's going to be some level of bloodbath, in fintechs in India. But eventually, my sense is the consumer is going to be a winner, because the process is certainly getting more efficient.
Right. Okay. Now, last two questions. Uh, so has your investment strategy changed post-COVID?
I think the short answer is no. Me and my partners, we aren't big believers that, look, we need to tailor our entire model based on what's happened in the next 6 or 9 months. I think when you're trying to build long-term companies, so you take an example of things like, ed tech, etc. Some of these are here to stay, because they've made it easier. Even the kind of meeting we are doing now, it's just made it much easier. In another time, there would have probably been an event where 20, 30 of us would have gotten into a room and we would have had this chat.
Right.
It's just made it easier. Some of these are going to last, but I think my sense is trying to build and back business models that are built entirely around COVID is not something we are a fan of. We feel eventually there's going to be some form of normalcy. Obviously, there will be some changes that are more permanent, but we aren't letting that instruct or dictate our core investment strategy.
So the approach is basically the same, maybe a little bit. Maybe you do a little bit more due diligence. You ask a few more questions. Yeah.
It is, and even the way we do due diligence and so on and so forth has changed, right, Sanjeev? I think this notion, for the first time, we are in process of closing deals where we haven't met the management teams,
Yeah.
right? And for someone who's been doing this a long time, if you'd asked me this question back in January or February,
Never have thought of
I
it.
would have said, look, no way we'll be able to write a check, without sort of pressing flesh, so to speak. You've got to see, the entrepreneurs in the eye, have a few drinks and dinner with them, get to know them, get to know the management team, because we all thought that was such core, to the investment process. That's changed now. We feel in a lot of ways this is actually a lot more efficient rather than fly somewhere, spend a day, sitting in a conference room and do a set of meetings with management team.
Right.
We're able to break that up over multiple Zoom calls, be more specific, etc. So time will tell whether this diligence is works out better or not. But I think we've all gotten comfortable of even doing our diligence very differently.
Yeah, but I agree. I mean, it's a far more efficient way. I mean, you may have to run a hybrid model, right? Where you at the end of the day, you will have to go look at a manufacturing asset or a plant or a facility. But there's a series of conversations that you can have either pre-investment or during investment or post-investment that can use the technology we have, right? Okay, last one, Raj, before we open up. So, I know you've been spending time in the ASEAN region, and I know you've made investments there. And I know you're not in Singapore on holiday. So, tell us a little bit about, how is investing in ASEAN different than investing in India?
Yeah, so in a lot of ways, the India funds have Southeast Asia and ASEAN as the adjunct. It's not China, it's not Asia, not North Asia, because a lot of the investment characteristics are different, similar. But again, remember, ASEAN itself is so many different markets who are dramatically different. You have a Singapore in there that is, by any metric, a very developed country, but it's a small local market. You have Vietnam, that's about 100 million people, $2,000 per capita GDP. You have Indonesia, which is closer to $5,000 per capita GDP, so more than 2x that of India. But again, in terms of digital adoption, etc., probably still a little bit behind India, in several of these aspects. And so it is fascinating to look at some of these markets. All of them are working very hard to just make themselves more attractive. And I think what's one of the things that's changing ASEAN very rapidly is this global trade war. I think everyone is looking for an alternative to China, certainly some of the global players. And all of these countries absolutely want to put their hand up. If you look at Indonesia, just 2 or 3 weeks ago, passed a pretty path-breaking rule. They call it the omnibus rule, which just makes it much more easier for, in terms of hiring and firing people, environmental clearances, etc. They made it much more efficient to be able to attract investments. And although it's controversial, as you would imagine, anything like this is, certainly the investor community seems to have reacted quite positively to it. And so, these are sectors which have good local talent, good entrepreneurial talent. A lot of them tend to be returnees, people who have studied out in the UK and worked there, or in the US, and then they're making their way back to Vietnam or Indonesia. They are the ones who are founding the companies, and then trying to build a local management team. But I think the attractiveness of each of these individual markets is the way we look at it. It's very hard to build a regional business. Even if you look at the larger conglomerates in Indonesia or Vietnam and so on and so forth, they're not regional by any stretch, right? They're very, very country specific. And so So I think I can, can count literally on one hand the number of truly regional businesses, that have been created, certainly on the
I
internet
see.
side of things.
So it's
Yeah,
somewhat like Europe in a way, right? I mean, the EU
very
like to think
much.
itself as it being, ubiquitous, but it's really independent countries, each one doing that. I see.
Yeah, the one difference is in Europe, you would still see a Spotify come out of Sweden saying that, look, I'm going to build this, but I'm going to build it from the get-go for the global audience,
Right.
right? It is a global market. You see that in India, when somebody is building a SaaS company, a product company, it's a fundamental, question that founders have to answer at the get-go that, look, is my market India or is it the global market, do I want to address? You don't see quite that much of that in Southeast Asia yet.
Okay.
You typically see Vietnamese entrepreneurs trying to address the Vietnam market, the Indonesian entrepreneur trying to do the same for Indonesia. And
Right.
so maybe in the next iteration, you'll start seeing some more global businesses come out, but you don't see that today.
Interesting. Okay, we have about 8 minutes left, but it's time. I can see at the bottom of my screen, there's one question that's come. So, what we'll do, as I mentioned, thank you all for being on the attending today. I can still see 37 participants. So we do have an audience, and I think simple protocol. If any of you is keen to ask a question to Raj, please on the chat box below, please send me a question. Also, obviously, indicate your name and the college you went to, because I know we may have a broader group today, and I'm happy to ask Raj. So let me see, Raj, what we have here. Now, all right. So I don't have the name of the individual, but it says, "What Indian homegrown PEVC funds does Raj admire and why?" It's a good one.
Yeah, I admire many. I think, there are folks, there are some relatively new. There are some who have been around. I think, Sanjeev, we all know the principles. I admire Chris Capital. They've done a good job. They've had the longevity. I think Kunal's done a really good job, after Ashish,
Yep.
and both of them have built a fantastic firm. I would say pretty much the same for Kedara, good friends of ours, and a fantastic firm. And amongst the newer one, someone like an A91 that are very, very focused on a set of things that they do really well around technology and consumers. And again, good friends of ours, in the firm. So yeah.
Yep. Yep, I agree. I mean, I think, I'm just a question. Has Chris Capital's investment strategy changed over the years since Ashish left, or it's pretty much the same?
Well, Kunal will and his partners will answer that better. But no, they, I think sectors that they've always known well, they continue to invest. I think it's IT services, pharma, etc. So they
Right.
continue to be strong investors in those
Got it.
areas.
Good. We have a second question from Subhadra Kunduri. He's an LBS alum. And the question is, what will be, this is a more kind of political business, what will be the impact of US-China trade war in the Biden presidency? Now that, of course, Trump has to give the keys to Biden. That's a separate conversation, which is playing out. But I mean, what's your take on that, right?
I think a couple of trends that started, I think, unfortunately, and I use that word deliberately, I don't think they're going to change, which is, countries starting to look more inwardly.
Yeah.
And so, it's a trend that is, I think to some extent that train has, left the station a little bit. And therefore, what a lot of the countries, including India, and this is exactly where the omnibus rule in Indonesia is coming from, is saying, look, how do we just make sure that we're able to build our local industries stronger? And it is going in a little bit of a different directions from the globalization, et cetera, that we've seen over the last 30 years that has served us all so well.
Right.
But my sense is, Biden obviously will probably work better with the allies and so on and so forth. And in areas like defense, those will certainly bound to happen. But from a business perspective, trying to change it dramatically,
It'll be tough.
I think it's going to be challenging, and it's something we've all got to be prepared for. And I think India particularly has just to make sure that we're able to come out net positive from a
Sure.
set of changes that are going to happen here. Yeah.
Okay, we've got a few more questions, so I'm going to run them through quickly. So here's the other one. How does the private equity market in India look right now with regards to the companies involved in COVID testing and vaccines? So it's pretty specific, right? And I don't, yeah, go ahead.
Yeah, I think the diagnostic companies have all done well. We have a diagnostic company that has done exceptionally well, and I think a lot of the tailwind from there, has been the COVID testing. That'll continue for a while. My sense is the level of testing is going to go up. Vaccines, I think there are 4 or 5 players in India. A couple of them that we hear about more than more than others, but they're not necessarily private equity backed. Well, perhaps one of them is, but certainly the largest of them, Serum Institute, isn't. And my sense is, I'm not sure if it directly is going to benefit an investor. Many of us would want to be an investor in Serum Institute, but we're not.
Interesting. There's another question from Aditya Sahai. Which sectors will give the maximum unicorns in India in this decade?
Look, good question. I don't have a crystal ball, but my sense is, the sectors that continue. So it is much harder to create new sectors than disrupt, large existing sectors. So such sectors that continue to have very large markets, large profit pools, and if somebody is able to build better business model using technology and digital. So I continue to think internet is going to be a big area. I think you're going to start seeing, and these might be Indian companies, but addressing global markets. But I think enterprise technology, enterprise SaaS companies, that are going to come out of India, addressing global markets, are going to have their fair share of unicorns. So my sense is those are the first set of things that come to mind.
Got it. This is Hiren Chandaria from again LBS. Again, any more LBS question, I'm going to start charging these guys. Right? But don't worry, Hiren, we're not charging you. Can you please share your views on impact investing? How is it shaping in India? Is there investor interest in vegan products? I'm assuming Hiren is a vegan, but vegan or vegan? Vegan is vegan, right?
I think vegan is right, but no, Hiren, good question. Impact investing, certainly has been getting more credence, more interest globally, and certainly in India as well. I think one of the things coming out of ESG is the investor interest, even in private equity, more broadly, around what you call the broader ESG platform. Anything that addresses the environmental, social governance concern, have dramatically gone up. You're seeing more for the first time, ESG focused private equity firms that are increasingly getting raised. So you will see certainly some of that. I think vegan opportunities in India, look, absolutely, it's a very large vegetarian population as people, become, more health conscious, more conscious about consuming less animal product for whatever reason, health reason, animal cruelty, etc. There's clearly going to be a market for that. But again, it's got to be an innovation. I think too often you see Me Too products, that come out, that struggle to get any real traction. But there's no reason India, just given the level of entrepreneurship and a captive market we have, for vegetarians and vegan, can't come up with something truly exciting. Yeah.
I have another question from an anonymous attendee who's a friend of mine. I have no idea. But the question from the anonymous attendee is, do you think the current situation is going to spur more distressed debt credit funds? And how important do you think their role will be in the near future, globally versus India?
So I think the short answer to that is yes. I think, look, first of all, the credit funds themselves in private equity, that category, I think I was looking at a statistic recently, in the last 10 years has grown over 3x. And they've stepped in where banks are increasingly refused to play, which is covenant light, debt structure, particularly in leveraged buyouts. But you're increasingly starting to see private equity firms come there. You're going to start to absolutely see more of that in India, but it's got to be a function of regulation and how easy it is. We had our, by any yardstick, the reconstruction funds, the asset reconstruction funds that came in India, probably had only limited success, not because there weren't enough opportunities in the market, but from a regulation and how resolution, how quickly could we drive that through, has always been tricky. So I think some of that is going to be tied to the regulations being friendly for distressed funds to be able to come and do their job and do their debt workouts and so on and so forth. Yeah.
Okay, I think it's the last two. There's a question from Madhav Gala from Warwick University. What do you think about the permissioned blockchain technologies and how it may integrate into the fabric of the global financial system in the medium to long term? It's interesting. Huh?
Yeah, blockchain. Look, I think it's always and it's the underlying, distributed ledger system. I've studied it a little bit. I'm not an expert. Fidelity, does some pioneering work, probably almost as much as any financial services firm, and we have a very large internal group. And when I speak to the experts, the view is, look, this is going to be the underpinning. Um, uh, you know, the question is, and the believers believe the question is not when, not if, but when. That we're going to start seeing a lot of these cross-border transactions or any transactions happening with the distributed ledger system, as the underpinning. So I think blockchain technology is here to stay. Bitcoin speculative pricing, the currency part of it, I have less of an opinion on, but yes, this is going to be a pretty important
Interesting.
aspect from everything that I read in here.
Very good. Raj, we're at 3:03, the last question for the day. What is the okay, now we're sorry, it's trying to bounce around here, right? So this is Kunal Thakkar, this is NYU Abu Dhabi 17. Does Eight Roads invest independently within its global portfolio? Are there any constraints placed on the portfolio to fall under a certain risk budget? What what does the fund benchmark against?
No, so we know the sectors that we think we understand. We absolutely know what we don't know, and we try to avoid those sectors. But like I said, broadly, technology and healthcare, consumer,
All right.
some financials. These are the sectors we invest in across the globe. We benchmark ourselves against all of the top, venture firms, growth capital funds, and even though we don't necessarily publish our benchmarks because we don't have to go out and raise external capital, that is absolutely how we're internally measured. And so yes.
Understood. Okay, the last one for sure. This is Riti Bang. What is the future of private equity investing in real estate in lieu of COVID-19? So this is interesting, right? So yeah, I mean, besides the fact like a bunch of NBFCs have always chased the real estate opportunity for various reasons, but what's your take from a PE perspective, right?
So the big caveat is I am not a real estate expert,
Right.
and I don't understand it. I know there are specialized firms that do that. I know the models are going to change. All of my friends in the real estate, private equity industry,
Right.
feel that there are some pretty seismic changes happening, both in terms of residential and commercial, just in terms of people moving out, people wanting larger spaces, they're going to be working from home, but also a lot of the firms looking at shrinking office spaces, getting into a hybrid working model, flexi desks, so on and so forth. So I think COVID has pushed a bunch of changes that is going to have some pretty important impact on the real estate industry. What's the direction of travel? Not my area of expertise, unfortunately.
It's a bit of a
So
punt sometimes. Okay,
absolutely.
buddy, it's 3:05. We've been good. We started, I think, 2:02, 2:03. But I
No,
think
thank you.
it's
It's been
been,
fun chatting. Yeah.
yeah, so Raj, listen, I've enjoyed the conversation. I'm sure we still have 30 participants on, so everybody stayed through it, hopefully listening to the insights you've provided. But it's been great fun. I hope you've enjoyed it too. Thank you again. If we were doing this in person, so that's the one thing you're going to miss. We'd have handed you a nice gift of some kind, which is not going to happen
I'll
today.
take a rain check on that, Sanjeev. And
When
when
you're
we
back
when we
in
meet in
Bombay,
person, I'll be sure to remind you of that. But no,
yeah,
thank you for
when you're
having me.
back in
It's
Bombay, we'll have a drink and we'll get together. But let's thank everybody again for signing in from wherever in the world they are, from whichever college they came from. Obviously, special thanks to the NYU and NYU Stern alum. Raj, thank you and thank Eight Roads for your being present and enjoy the rest of your month and a
thank
half
you.
or so in Singapore. May God give you many more deals, right? And we hope to have another round one of these days. Yeah. All right.
Absolutely. Thank you. And it's been a real pleasure.
Thank
And,
you.
and, and, and speak soon, Sanjeev. Thank you.
Take care, buddy.
Cheers.
Take
Take
care.
care.
Thank you
Thank
all.
you. Bye. Bye.
Bye.
Bye.
Bye.